Hello, everyone, and welcome to this month's edition of The Pitch. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a very rainy Redmond, Washington. Thanks for joining us for this fantastic stock picking showdown. We have three great guests today to help us make sense of things. The market's overall in distribution mode. We've talked on my show, The Final Bar, about some of the concerning patterns that we've seen. It's all sort of coming to fruition as we're recording the show here midday. And while we're going to talk, I'm certain about the short-term dynamics, but this show is really about the long-term ideas, right? Or the picks that make up this market environment. Where should we be looking opportunistically given the overall environment that we're in? We have three great guests today to join us, and we will be featuring these three together. Number one, we have Tom Bowley. Tom's the Chief Market Strategist at earningsbeats.com. We have John Kosar. John's the Chief Market Strategist at Asbury Research based in the Chicago area. Finally, we have Joe Rabil. Joe's the founder and the president of Rabil Stock Research and the host of Stock Talk with Joe Rabil on StockCharts TV. Gentlemen, thank you guys so much for joining me. I'm really, really excited to chat with you. So thanks for coming on today.
Thanks for having us.
Thanks. Great to be here.
So everyone, just so you know what to expect today, here's basically how it's gonna work. We're gonna introduce each of the sort of guest contributors, guest panelists, one at a time. We're gonna start with Tom, then go to John Kosar, then go with Joe Rabil. They each have about 10 minutes to present their 5 stock picks. I'll be following along with the charts and show you visually what sort of things they're thinking. And again, they have 10 minutes to pitch you their 5 particular ideas. After that, we'll change mode a little bit. We'll do a bit of a Q&A session and discuss those 15 picks as a group, talk about a lot of the things we're seeing big picture, the distribution we're seeing today, how that fits into the overall environment, how we can identify ideas in any sort of market environment in particular, and what sort of opportunities we see between now and year end. So it should be a lot of fun. Let's start. Tom Bowley with you. Tom, listen, you're a name and a face that I know is familiar to many on StockCharts TV. You've been a longtime StockCharts contributor. Your show, which runs, I think, Tuesdays and Thursdays, 9 a.m. Eastern, I think. Is that right?
That is correct, yeah.
Trading Places with Tom Bowley. So I'm humbled, as always, to introduce someone who knows StockCharts way better than I do, and you're absolutely one of them. You have 10 minutes. Get us started with the S&P. What are you seeing?
All right. Well, I always like to look at the big picture in the market, and that's why I wanted to feature this chart first. And it actually is a good day to do this because with the market selling off today, sometimes it's best to kind of take a step back and look at what has happened and kind of where we are in the process from a long-term perspective. So this chart is just something that reminds me that we go through periods of secular bull markets, secular bear markets, and you can see those secular bear markets are highlighted in the red. There's red shaded areas where the market tends to go nowhere for an extended period of time. But when we break out of those, we tend to go for up to a couple of decades of long-term gains. Of course, you have pullbacks, you have corrections along the way. But I think it's really important to understand the money flow and the rotation between various asset classes. So I think we're in the midst of a secular bull market. I've been saying it. I said it through the trade war. I said it even through the pandemic when we were getting hit really hard in the first couple of weeks. So I think this is a chart that is worth continuing just to keep in mind. The other thing that I wanted to point out on this chart is that since April 10th, 2013, you can see a listing of the sectors. And this is the performance of each of the sectors since we broke that double top back in April of 2013. And you can see that the more aggressive sectors are the ones that tend to perform and outperform throughout secular bull markets. So when I'm looking in pullbacks like we're getting today, I generally will look into those aggressive groups, the technology, the communication services, consumer discretionary. These are the areas that I really want to be focused on. So I just wanted to start off with this chart just as a little bit of a backdrop as to how I approach the market. So from a longer term perspective, this is a time that I would actually be looking to begin to build positions if I wasn't already in them. So if we look at the next chart, we can talk about my first theme, which is the transports. Transports. This is a 10-year chart that you're looking at with the S&P 500 on the top and transports in the middle, and then the correlation between the two at the bottom of the chart. And my point here is that they tend to go hand in hand, and they should. When the economy's strengthening or expected to strengthen, you would expect transports to do well as they ship more goods. You'd also expect the S&P 500 to do well as profits grow. So this chart just shows you the correlation and how the S&P 500 tends to struggle when transports are struggling. If you look at the last 4 months and down at the bottom of this chart, Dave, you can see that correlation has gone inverse. And that is the most inverse that this has been on a weekly chart over the last 100 years. I've never seen transports diverge like they have in the last 4 months versus the S&P 500. Longer term, we're fine. And I think if you look at the middle part of this chart, right where you're pointing there, we had such a huge run in transports. I think we just needed some consolidation, and that's what we've had. So I think this pullback actually gives us an opportunity to move into the IYT, which is the ETF that tracks the transportation group. If you notice there, I've circled right near that 50-week moving average. We had a bullish engulfing candle that printed last week. So I think any kind of a pullback this week gives us an opportunity to get in with solid reward potential versus low risk. Moving on to my second idea, you can, yeah, looking at Fastly, FSLY. This is a stock I think that's been forgotten for quite a while now, and for good reason, because the stock's been downtrending for quite a while. But once again, if you look back to 2020, Fastly had a huge run up from, I mean, it's probably gone up 10 times in maybe 8 months. And when a stock does that, you tend to see a period of time where it does pull back and give us opportunities to get back in cheaper. And I think the support area there on the stock is right at about $35 on this weekly chart. So that prior high that we saw back in 2019, when it was eclipsed in 2020, that prior resistance becomes support. And we just tested that at the beginning of August. And on my next chart, with also looking at Fastly, you'll see that that coincided with the earnings report that came out at the beginning of August. I believe that's an exhaustion gap. I think that we've gone down for many, many months. You can see that hollow candle where we actually closed above that low. So I'm watching Fastly, that support area down around $35, which is where we opened after earnings. I think as long as we continue to hold that, that this is an area that we could certainly launch from. So Fastly would be my next um, stock that I would be interested in. And if we go down to the next one, we've got Open Door Technologies. Now, I just wrote a blog article this morning talking about small caps and mid caps and how they tend to outperform when the yields are rising. And Open Door kind of fits in with that theme. It's about a $12 billion market cap company, I believe. And what's interesting about this is I ran a scan, and Open Door, ticker symbol OPEN, is one of only two stocks on the New York Stock Exchange or the NASDAQ that have closed above their open for the last 10 consecutive days. That's that blue shaded area, and you can see all those hollow candles. If you go back just before it, I didn't highlight it, but from middle of August to the first week of September, it had a very similar period where it had almost all hollow candles. Volume's been strong. I think the stock's being accumulated. So I think any kind of a pullback here actually represents a pretty good opportunity to jump into Open Door. So my fourth pick, I'm going to give you a little background here first before I get into them because they're both in the consumer discretionary area. I just want to point out that consumer discretionary, after 4 times failing to get through that 185 level, we did finally break out yesterday. Now, of course, today, just as, of course, everything seems to work, you got the big breakout, and now we're kind of pulling back and going back below that breakout level. But I still think that the long term looks pretty good here for consumer discretionary. And if we go on to the next chart, this is a longer term relative chart looking at consumer discretionary stocks. And you can see that the long term at the top of the chart, you can see that long term relative strength has been very solid for the last 10 years. But we do go through periods where money rotates. And as you were pointing out, there's like a relative bullish wedge that we just broke out of on the XLY versus the S&P 500. So I think that combined with that recent breakout on that absolute chart, I think is providing some opportunities. One last thing I'll point out here on the XLY, if you look at the PPO, this is a relative PPO. So this is the momentum of consumer discretionary relative to the S&P 500. If you look at that -1 level and go back 10 years, I've drawn those the blue vertical dotted lines, the blue dotted vertical lines. Those all coincide right at about that -1 level, and that's where we've seen consumer discretionary in the past start to move, and that's where we've just coming off of now. So this is kind of setting up my last two stocks. Just looking at these consumer discretionary charts. So let's move on to Domino's Pizza. Everybody likes a good pizza, and probably some of you might disagree about Domino's being a good pizza, but I do like that big earnings move that it made back in July. It opened up at about 484, made a huge run up, and the stock has worked its way over the last 2 months, all the way back down to that open where we saw all the volume, all the buying coming in. I think that this gap support area is an interesting area for Domino's Pizza. And if the consumer discretionary group does begin to lead again, I think you're gonna see a lot of traders rotating into stocks like Domino's Pizza. So I think this one looks pretty good. And then my last chart, Dave, you know what I'm going with. It is, yeah, we'll just go on down and take a look at the last one. Tesla. Tesla, I've been a big fan for a long time. I wrote about Tesla at the end of 2019 because of the massive short interest that it had. And it broke out back in 2019, I guess, made the huge run all the way back to January 2021. You can see where we hit that 900 level. And then we've been consolidating. And I actually remember listening to you, Dave, on Final Bar talking, or maybe it was in one of our other discussions that we had. But when it broke above 700, it cleared that triangle pattern that it had been in. I think that consolidation phase. And I believe Tesla is now beginning to run higher again. They've got earnings coming up in a few weeks. I wrote a blog article about Tesla, and I'm trying to think who else it was. There was another company that has a history of making big runs into their earnings reports. So I think Tesla could be one that is ready to make a big move. I think it's my best idea. I like Tesla. I've been a fan of Tesla, and I think we're going to make a run for 900. So that would be my fifth stock today.
I'd be so disappointed if you hadn't brought Tesla with you, Tom. I'm hesitant. I'm excited, but not so excited to. I know we're going to be recording a follow up to our Chart Madness special where you talked up Tesla. I'm fairly certain. I don't remember exactly, but I feel like I took the other side of that, and so far you're being validated very well. I'd love to just ask you very quickly. So you hit on an interesting point, which was the relative performance of consumer discretionary, right? And a ratio I look at a lot is the XLY versus the XLP. And you've seen that situation where even where the market's been a little bit unstable, you've seen consumer discretionary do just fine on an equal weighted basis, even, right? The average consumer discretionary stock is doing better than consumer staples. When you're approaching this exercise of trying to pick five names, how much of it is thinking about sector movements and then looking a little level down and then looking at names within there versus just looking for good patterns across the board? Like, how did you generally approach this?
Well, I mean, I'm certainly looking at things that are going on. I mean, the 10-year Treasury yield beginning to move higher certainly, I think, gives a potential for a move in the transport. So that's why I went there. But you raised a great point with the XLY versus XLP. That's one of my favorite ratios to just follow the market and whether I believe a rally in the market is sustainable. And when that XLY is outperforming the XLP, that's generally a good sign. I just looked at that chart yesterday, so I know exactly what you're saying. I believe we just set a new high on the XLY versus the XLP. And I think that's really bullish for the market, even though we're having a rough day today. Anytime the consumer discretionary names are doing well relative to staples, that makes me believe that these moves to the downside are temporary.
So, Tom, really appreciate you joining us. Of course, your five picks, just to review for everyone, you had the iShares Transportation Average ETF, the IYT. Second, you had Fastly, FSLY. We went into the real estate space. It's kind of a techie part of real estate, Open Door Technology, OPEN. And then two consumer names, Domino's Pizza, DPZ. And finally, Tesla, TSLA. Thanks so much. Great picks and appreciate you talking through them very much.
Thank
John
you.
Kosar, thank you so much for joining us today. It's really, really good to have you on the pitch joining us. John, when I think of you, I think about the Asbury Six. I think about Asbury Research and what you do to sort of make sense of the overall environment. I know you've done a great job, sort of helping your customers sort of navigate this entire environment. I know when you've come on my show, The Final Bar, we've talked about some of the concerning signs with which what we've both seen at times. I'm very interested to see what five charts you brought with you. You're starting with Brunswick Corp, ticker BC.
I picked this stock because one of our internal models, it's called the SEAF model, it's sector ETF asset flow. So it's measuring the money that's going around the board, so to speak, in the 11 sector spiders. And one of the sectors that showed up in the model through last week was consumer discretionary. So that tells me to look there for opportunities. And this is kind of a simple chart here. We've got the daily price here going back, looks like it goes back to the beginning of the year, and you've got the 200-day moving average right underneath there. So it's been sitting on that for maybe 2 or 3 weeks. If you're one that looks for patterns, you might even see a little inverse head and shoulders pattern there. So then the next thing I want to see, now that I know according to our model that there's some money, there's an unusual burst of money that is going in there. I want to see if the momentum is picking that up. So then we go to that second chart underneath, and that's just the simple MACD. And you can see that it's starting to turn higher. And if we move our cursor over to right to the beginning of June, you'll see the last time that we had a similar situation there where it didn't actually get down to the 200-day. It kind of gave it a look, but that was the start of a pretty nice move higher. So now we know we have money going in there. Now we know we have a little bit of momentum working. And then if you go down to the bottom and you see the stochastic, that's a monthly stochastic. That's our tactical time frame here. And not only can you see it's coming out of oversold territory, which typically, if a trend is good, if a trend is solid and healthy, when you get down to support and you become oversold, that should ring a bell. And if the trend is still intact, which we think it is because there's money going in there, that should be a place where you can buy with relatively good risk reward features. And the other little thing in there, for those who like nuance, is there's a little bullish divergence there. You had a lower low there at the bottom, up top there, and then you've got a little bit higher high. So that just means your momentum is starting to shift upward. So obviously, the market's getting murdered today. I wanted to buy something that at least had some good sector activity with assets going in and something that I could really control the risk. And this allows me to do those things.
Very good. Chart number two, we're switching to financials, Comerica, CMA.
This is Comerica, and I wanted something that represented interest rates, that took advantage. The market's vulnerable. I think it's been vulnerable for a few weeks. Our Asbury 6 has been negative since September the 14th. So we were kind of got a reprieve today. The market kept going higher, and we're finally seeing some of the fruits of our labor, so to speak. But what I liked about this is, one, it's going to take advantage of higher interest rates. The yield of the 10-year is up around 150. Our next level there is like 170. And the way interest rates move, it typically kind of goes in a burst from one level to another. So assuming that interest rates are going to keep going up here, this stock has just had a nice test of the 200-day moving average a few days ago. And most important to me, when I think the S&P is going to go down or it's vulnerable and going down, I want to find something that's going to outperform it. So on the bottom, you see the daily relative performance of CME versus the S&P, and it's a 63-day moving average, which is one business quarter, and that's our strategic time frame here. So what you see there is kind of fluttering around the moving average through the backside of August. And then we had that burst higher. So not only do we have a 50-day and a 200-day moving average to lean on up top, we also have some relative performance in our favor too.
All right, now we're switching gears a little bit. I want to think. I believe, knowing all of your picks, I think you're focusing a little more on energy than others on the panel. Talk us through the XOP.
I am. The primary reason for that, again, is going back to our SEAF model. 2 weeks ago, that showed energy as having the most concentrated new money going in on a weekly and on a monthly basis. So that makes us look there for opportunities. So here's XOP. Tested the 200-day up top there about a week ago. You can see we tested it once, kind of broke it, but then that second test held. And here's our relative performance chart again. We had a nice little breakout of that 63-day moving average. That's the relative performance of XOP versus SPY. And then it came back and kissed it right when we were coming off the test of the 200-day moving average. So now I can control my risk up top because I've got the 200-day moving average to lean on. And I know even if the stock market gets whacked a little bit, and it's certainly getting whacked today, I've got some relative outperformance in my favor. And for a lot of managers who have to be invested in the market, at least to a certain degree, all of the time, they're looking for ideas like this to get them through tough days.
Your fourth one, sticking with the same theme, looking at the XLE, the energy ETF.
Yes, this is the one that we actually got the signal in our model 2 weeks ago to overweight energy. The chart that I looked at today for this, and we don't have it, but it's a chart that shows the total daily net assets invested in XLE, and we get that by simply multiplying the shares outstanding and the NAV, net asset value, and you multiply that daily, and it gives you a dollar amount. So you can see the relative performance is quite nice here in that last little sliver of the chart. But the part that I was looking at was about 2 weeks ago, I saw those assets starting to expand, and that's a tactical indicator for us. So we actually overlay a 21-day moving average on that. So once it started expanding, those assets started expanding on a monthly basis. That told me, in combination with the model, that there was some horsepower here and we might be able to catch a burst. So that's why the interest in energy. And again, I was looking for something that wasn't going to be Apple or wasn't going to be one of Microsoft, one of the ones that have been dragging this thing higher for most of the year, because we saw some evidence that there was going to be a correction, and I was trying to move in something that wouldn't be as adversely affected by a huge drop in the overall stock market.
Very good. And then finally, the UNG, the natural gas ETF. Talk through this one.
This was a monster move, and I don't think it's over yet. We first put this out as an idea right at the end of August, the last week of August. And what we were looking at, this is relative performance again. So again, when you think the stock market is overextended, and again, I think the S&P was as much as 105% higher from its bottom that it made last year in March 27th. So we're looking for places to hide money, so to speak, alternate places to push some money when we get the inevitable correction, which we may be seeing the beginning of today. So this chart's kind of simple. It tested the 50-day moving average right there in the latter part of August. That's what we were watching. It held it, started to move higher, and notice the outperformance right underneath it. It came right down to its 63-day moving average versus the S&P 500, and then it started outperforming. And it's exceeded our expectations. I think it's up 30 or 35% or something since you put it on. I had no idea it was going to go that high, but I liked the fact that it wasn't the S&P 500. It was holding its support level. It was starting to expand. And first and foremost, it was outperforming the S&P 500. For me, why buy gold or why buy a commodity if it's not outperforming the S&P 500? The S&P 500 gives you some stability. There's 500 stocks there that act as kind of a damper on each other. And when you're buying something that's natural gas or energy or lumber prices, they're a lot more volatile. So I'm going to make sure I've got some outperformance there before I look to put money there.
It's 5 fantastic picks, John. Just very briefly, you picked a couple ETFs as opposed to looking at individual names. And the UNG, by the way, is one of the top ranked ETFs using our StockCharts technical ranking, right? Ranking all the ETFs based on their trends. It's one of the top scoring ones. When you're approaching an exercise like this, what compels you to think of things more as a sector bet in terms of like energy, XOP, broader stuff versus individual stock picking within that group? Is it because of the patterns of the stocks, or is it just more expressing a point of view, which is energy is a good place to be? How do you think of the ETF versus the underlying stocks?
Great question. Um, if I'm going to buy an ETF that's got 30 or 40 stocks in it, it's going to tamp down that individual volatility that you might get in
Hmm.
one stock. Or you may like energy and say, out of these 40 energy stocks, I'm going to pick ABC. And Murphy's Law comes and your stock gets creamed and the rest of the energy sector takes off like a rocket. So for me, that's one reason is I'm making a bet on the sector. We have a model that measures the money moving in out of there, so it tamps down the volatility. I can see the money going into the sector. And thirdly, I can watch those total net assets going into the ETF and use those as a futures trader would use open interest as it moves in and out of bonds or something like that.
Very, very good. John, really appreciate you coming on and sharing with us your 5 picks. And as a review, you started with Brunswick Corp, BC in the consumer discretionary sector. We then went to financials, a little interest rate play, getting Comerica, CMA, and then 3 ETFs, all focusing in sort of that energy space. The XOP, the oil and gas ETF, XLE, the energy sector spider, and then UNG, the U.S. Natural Gas Fund. Great picks, and thanks again, John, for talking through all of those. Joe, I appreciate you being patient, and thank you so much for finishing strong and being our third panelist today. It's awesome to have you on.
Glad to be here.
Now, I know, as I mentioned in the introduction, you're doing a great job with your show. It started not too long ago called Stock Talk with Joe Rabil, and it's on every Thursday at 2 p.m. Eastern. And to just remind people, it's a really interactive show. You do a great job of addressing people's questions on those. So thanks for what you're doing there. I want to get to your charts. Start us at the top. We're actually going to the transportation space, so an interesting overlap with Tom Bowley earlier. AAL, American Airlines. Talk us through this one.
Right. So this is a little different. I mean, I'm not typically one to look at these big turnarounds, but when we're in the situation that we're in, where the general market is pretty extended, it hasn't broken down yet. I tend to shy away from the really strong leader stocks right now until we get a little bit of an ease off of this overbought condition, and so I start to look for stocks that look like they're showing signs of a real turnaround. And so what I've done on this chart, typically, as you know, or if anyone who's ever watched my show would know, I like to look at multiple time frames. But for this, I thought it would be easier just to show one time frame. And then what I've done is this big, thick green line is the 18-month moving average that I've overlaid onto this weekly chart. So all the charts I'm looking at are weekly. I'm trying to find stocks that I think can do well over, say, the next 3 to 6 months. And so what I've got is a 18-month line that turned down a few years back and had been declining. And now we not only cross back above it, but that line is actually turning up. And so I use the 18 in each time frame. I think it does it's a very good barometer for the trend in each time frame, as well as a moving average can do, in my opinion. I mean, you can use a 20 if you want, but I like to use the 18. I've been doing it for years. So, um, what what intrigued me about this was not only did the 18-month turn around, but if you notice on the move to the upside, I've got two indicators down here. One is the ADX down at the bottom, and then the other is MACD. And both of those made a very strong move to the upside on this move up. And ADX reached almost 50 before starting to pull back. And so I kind of view that as it's somewhat intriguing to me, where we're showing strength from the buyers, because that move in the blue line is based on the buying strength, the green. And so that tells me that the buyers have finally started to step in this for the first time in quite a while. So I find it interesting. Plus, we're getting a pullback to the zero line. Now, most times you'd like to see the MACD come down maybe a little bit more. But in this case, when you had a strong move to the upside, I actually like to look for zero line reversals. So that's kind of what's taking place here. So yeah, I think this is intriguing. I think it's trying to turn the corner, and I'm noticing other stocks, not other airlines and others that have this similar pattern starting to turn up as well.
Chart number 2, going to consumer discretionary, Texas Roadhouse.
Yeah. So this is interesting because I went through all the stocks in the Russell 2000. And one of the things I wanted to mention is that on a relative basis, I find it interesting what's going on in the Russell, because right now, if at some point maybe we can pull up an S&P chart and you look at the August low was broken recently, and now we're below it. And so we made a higher low on the S&P and a low. So we've actually made a lower low for the first time in the S&P this year. And so I'm actually looking for the stocks that are making higher bottoms above that August low. And this stock is doing that. And it's also one that had a very strong ADX reading. It had a strong MACD reading. And now we're pulling back towards the zero line. These zero line reversals in stocks with very strong ADX condition are usually pretty interesting. Now, I have drawn a trend line in. I think we want to see this get through that trend line. And actually, I wouldn't mind it being emphatic. I'd like to see it get through 100, big round number at 100 after consolidating like this. But this was a stock inside the Russell 2000 that I thought looked interesting. I got to tell you, the Russell 2000 made a huge move and has been pausing for about 3, 4, 5 months. Hasn't done anything. It's very quiet. It's been ignored. But if you look at today, the market's getting crushed. It's basically the best performing index, which I find interesting. It wouldn't make sense. Typically, you wouldn't think that. So I'm sort of intrigued by that. So that was part of the reason why I looked at this Texas Roadhouse.
Very, very good. Your third stock, staying in the same sector, sort of the travel theme, Playa Hotels, PLYA.
Yeah, so this is actually representative of kind of what we're seeing in some of the hotels and casinos and stuff like that. There's definitely been some strength recently. And this is another one. It's a $1 billion market cap. I don't know that it's actually inside the Russell 2000 necessarily, but it kind of represents that same kind of stock. And it's another one where what I wanted to point out is you see, I have those arrows earlier. Yeah. So that represents the last low in the price chart. And if you notice, we're making a higher low, right? We made a higher low from that. But if you go and look at the MACD, where that same arrow is, we're actually making a lower low. So I refer to that as reverse divergence, where instead of making a lower low in price and a higher low in MACD, we're doing the reverse of that. And I find that intriguing, especially when we're coming back down to the zero line like this. And so just caught my eye. Now, this gotten a little overbought. I mean, I was kind of hoping it would pull back a little bit over the course of the next few days and maybe look a little bit more attractive as we were putting on the show, but it actually has gone up. So it's something to watch, I think, for a pullback, but very intriguing.
All right, your fourth one now going to the energy sector, Royal Dutch Shell.
Right. So I know John mentioned energy. I like what's been going on in energy, and look at what's happened to the 18-month line in this stock. So I'm noticing a bunch of stocks where you could go back 2-3 years, the line has been declining, and look at how it was acting as resistance going back a couple years, and now it's actually starting to turn and provide, I think, support for a potential trend to the upside. And it's been a really quiet sideways pattern. So if we go and look at the ADX, so instead of having strong ADX, we have low ADX. And that is often the precursor to a move in a stock. And it's almost like it's building energy when it's quiet and more working sideways like that. So when I see that, I'm sort of interested in buying breakouts. The MACD didn't actually make it down to the zero line. It's more like, I call that kind of like a flyby. It's kind of buzzing the tower, but it's not touching down. It's cupping around there, but it's done it in a really orderly fashion. And it looks like it's starting to turn up now. So really interesting pattern here. There is some room before we hit some more meaningful resistance up mid to high 50s. So I think it's something that could be played in here right now.
And then your final pick, potentially an interest rate play here, PNC, ticker PNC.
Yeah, one of the other things, when I went through all the Russell stocks, and you're going through 2,000 stocks, you're just sitting there, but there are so many regional banks in the Russell, and they all have this similar pattern where they made this strong move to the upside. And the reason why I say this is strong is look at the ADX reading on the way up. It got up to like almost 50, and there's just a host of stocks in the regional banks that have this big, strong reading to the upside. Now, we've been pulling back in that blue line. That ADX has dropped down, and now it's down to 11. It's getting oversold, and MACD is actually worked down back to where it kind of broke out there. But notice how price isn't going down. So it's almost being resilient during this pullback. And when I see indicators get oversold and without the price pulling back at all, I usually think that's really an interesting pattern. And so there's just a bunch of stocks in regional banks. This is kind of just the poster child. But you could look, if you go through and look at a lot of these, you'll see a very similar pattern developing.
It's interesting. I should point out, I don't think I made it clear. Your charts are all weekly here that we're looking at, Joe. And you mentioned before that you like to look at multiple time frames. Can you talk a little bit, especially on a day like today, where some of these charts that you're showing are doing just fine. Some of them pulling back a little bit across the equity markets. How do you reconcile the short term movement with sort of the long term weekly? How does that relate for you?
Yeah. So a lot of times, I'll be zeroed in during the day and I'll be looking at the daily chart and even the hourly chart. And then, I'll pull back over, when I do my review at night or on the weekend, I'm like, "Pff, nothing's even happened here. I mean, it's just noise. And
Yeah.
so it really helps from that standpoint, keep you centered on what is the real trend. And that's actually why I look at the monthly chart. I do a lot of work with institutional clients still. And they're looking at bigger trends. So I like to start there, go down to the weekly, and then time it off the daily. But if you start looking at the daily before you're getting confirmation on the weekly or the monthly, I think you can get trapped and have a lot of false moves that take place. So that's the reason why I do that. But frankly, when I'm looking at charts, I'm looking at four time frames at once: monthly, weekly, daily, and hourly. I have them all up at the same time. And if I want to play, or if someone wants to play a short-term trend, you can do that. You just have to recognize what's going on the bigger time frames to help you with the targets and how much room you have from that standpoint, and whether you're playing with that trend or against it.
That's a great answer, Joe. And I remember early in my career, I spent a lot of time with hedge funds. We were looking at 1 minute charts, 5 minute charts, hourly charts. I went to Fidelity. I don't think I ever brought another one of those up again. It was all weekly and monthly charts, trying to understand the long term trend. So I love that interplay of the time frames for sure. Just to review, Joe Rabil, your picks. You started us with transports, looking at American Airlines AAL, then went two names in consumer discretionary: Texas Roadhouse and Playa Hotels PLYA. Then we went to energy, Royal Dutch Shell, and then finally a regional bank, PNC. So picking on a number of different sectors there. So let us, folks, transition into the second half of the discussion. Really, sort of talk through the overall environment and how we kind of came up with these picks and how we're seeing them. I mean, we have to address it. Just sometimes the big picture does not need to come up on the pitch. And I know in previous months we've sort of, it's yep, things are kind of normal, and then we talk about some of the picks. We're certainly having a lot of movement today. So I want to start, if we can, before the show, a number of us who are noticing. I know, John, you pointed out the Nasdaq 100, which is actually testing its support. If you think of this as a potential head and shoulders pattern, we might actually be breaking the neckline. Today, if you're looking at the S&P chart, why don't we start there? Because that's one that I know many are familiar with. Right now we're testing the lows that we've had over the last month or two. We've certainly seen some short-term distribution. Tom, if we could start with you, I mean, what would you need to see on this chart to get really defensive, or to start to think this is really has the potential to be a deeper decline at a macro level than what we've seen so far?
Well, I think we've had such a strong year. I think anytime you pull back, you've got to, at least be thinking that, we could be starting something a little bit more significant. I look at a lot of intermarket relationships to try to determine whether or not I feel more bullish or bearish from a more intermediate term perspective. So I'm talking about, maybe 1 to 3 months as opposed to 1 to 3 weeks. But I think right now, and I believe I don't see it on this chart, but the 20-day moving average. I think the S&P, when it made that last move last week, it went up and tested the 20-day and couldn't get through, and then rolled back over. So I think to the upside, what I'd want to see is I want to see a move back through that 20-day moving average. Until I get that, I think you got to believe, at least in the near term, that path at least resistance is to the downside. Now, having said that, the one other thing that I like to look for, if you look at all of the major indices in many of the sectors, we have maintained very strong AD lines, accumulation distribution lines. And the way that that gets factored in, for those maybe who are not familiar with it, if you close in the upper half of a candlestick, even if you're down for the day, if you can rally in the afternoon and close back in the upper half, that's actually a positive for your AD line. And so one of the things I'm going to be looking at today is how we close. If I see afternoon buying coming in, and this turns out to be a day where there's actually more accumulation than distribution, even though we're down, I would view that a little bit more positively than the alternative, where we just sell off all day and finish down near the lows. So I'm going to be watching, the rest of the day, and I tend to be a fairly short-term trader. I do want to say, it's always such a pleasure to listen to a couple of other technical analysts that I have a lot of respect for. So listening to Joe and John give their take on the market and on these various, their the different strategies that they use to pick stocks, I think was really enlightening. I really enjoyed it. I'm actually jealous of you, Dave, because you get to do this on the final bar every day. So many.
I have so much fun talking with you guys. I mean, you guys are all. I mean, you guys deserve a broad platform for people, which you all have to draw on your experiences. You guys really know you know your stuff, and it's awesome to have you on here. You hit on some really interesting points in there, Tom, and particularly thinking about the close. I know I fell into the financial media trick. The moment I see something breaking, I throw it up on the screen, and it's a great reminder. We're recording this, midday on Tuesday afternoon as we're getting a sell off. The market could return, and this day's bar could always look totally different by the close. That my show is actually called the final bar because of how important that is to actually look at what the final bar is doing to make the conclusion. That's a great point, Tom. John, you had mentioned the Asbury 6 in passing as you were talking about your stocks, and I think you mentioned that they turned negative mid-September, if I heard you right. Can you talk about? I know that we've talked about the Asbury 6 when you've come on my show. It's looking at different components, breadth and sentiment, all kind of mixed together. But what is it about this market environment over the last couple of weeks that's turned that macro indication from positive to negative?
We were seeing some, I'm going by memory now, but unbalanced volume started to roll over in the S&P 500. The total net assets invested in the spider started to roll over. Market breadth started to roll over. So this was the A6 went to negative on the 14th of this month. And it was a long week or so, kind of watching it stay negative and kind of waiting for the market to catch up. So it's obviously doing that today. But the reason the Asbury 6 is not the Asbury 2, there's only one of the six that have to do with the price of a major index, and that's the monthly rate of change in the S&P 500. Because I want some indication of if the market is listening, so to speak, to these, what I would call secondary indicators. And sometimes there's kind of a disconnect. And that's what we had this time. You saw some of that weakness showing up in some of those secondary indicators. And it took the market a little bit of time to catch up to that.
Very, very good. Joe, when we're talking about your picks, and I don't know if you explicitly said this or just implied by what you didn't pick, but I can't help but remember, I believe on last month's The Pitch, where we had three different contributors, and I won't point out who they were. They were all fantastic. But we did end up talking a lot about the FANG stocks because at the time, and if you think about a month ago, the FANG stocks looked pretty incredible, right? I mean, they're all just sort of pushing the market onward and ever upward. None of you, I can't help but notice, picked any of the what I call the fan mag stocks. If we throw things like Microsoft in the mix, you have the six mega cap sort of tech consumer communication names, which are on my screen right now. And none of you picked any of them. What is it that caused you to lean away from these? Now, you obviously went small as opposed to mega cap in general, too, with some of your picks. But what did you see or what did you not see on something like Microsoft or Apple that makes you think this could be a place to hide out right now?
Well, when I'm evaluating an individual stock, I look at longevity of the trend and whether you're overbought or oversold. I mean, those are two pretty important parts of the puzzle for me. And so even though the momentum might be good, it could be a really strong stock, looking at it from a longer term perspective, could have like all, trends are all up. But if you're overbought and kind of extended away, for me, it's the 18-month line or the 18-week line. And that trend has been going for quite some time without a correction, then I'm going to tend to shy away from that. It's just kind of like asking for problems, especially if there are other things that are looking attractive, that are showing signs of shorter, like more improvement on a relative basis, probably more on a shorter term basis, but also showing like bigger picture pattern reversal. So I'm going to probably lean more in that direction. And that's where these stocks came from for me. And it's also the reason why, out of the list there of those big names, not Netflix, I think looks pretty good. Amazon neutral, Microsoft's going straight up. I mean, Netflix has been going sideways. It's trying to break out of here. It just hasn't quite had the follow through. But I mean, if I'm looking at one of these, this is probably the one that's the most intriguing to me because it's not going through a big run to the upside. I mean, Google has been going up for about 100 years. It's just straight up. And today, I think it's the first time someone's ever sold the stock today or this week. So, yeah, I mean, I'm just looking at it like at some point, I don't want to be the last one holding the bag on those. And if they pull back and they correct the right way, yeah, I'm interested again.
Yeah.
Um,
It's interesting. I would say Tom probably out of all of us, you probably pick the most Fang-like name if I'd consider Tesla maybe in that bucket. Although I know it's a very different thing and everything. So I have to ask you now that I have you on the spot and I can ask whatever I want. What would you need to see on the chart of Tesla to turn negative? What would tell you this is done? The theme is over. Technically, this is a raging sell. Is there something that you would need to see from the price action that would tell you to avoid something like this?
Yeah, well, I'm an eternal optimist. So, you're asking me to do something I'm really not comfortable
I
doing.
just wanted to get you on record as saying something so I can hold you to it at some point.
You just want me to say something negative about Tesla. You still got what, another 15 minutes to get something negative out of me. Um, no, I'm a fan of Tesla. I think one of the things I look for, and it was mentioned by John and Joe. I mean, relative strength is so important. Why be in a stock that is showing that it can't keep up with the benchmark? In the case of Tesla, when you look at Tesla versus the SPY, the long-term track record of this stock, and I say long-term, I'm talking about the last couple of years, been a tremendous relative performer. And it went through that period back in February, May, when many of the growth stocks got hammered. Yeah, you can see that the relative strength really deteriorated during that period. But it's one of the stocks that's now starting to strengthen again on a relative basis. And also the AD line, before we got this recent breakout, the AD line was already starting to set new highs. So I'm just seeing too many signals for me that the stock's being accumulated. And when I see that heading into an earnings report, I tend to believe that we are going to see an absolute blowout by Tesla in another month or so. So, did I say anything negative in there?
I was going to say you somehow turned my pin you down question into another dose of optimism for Tesla. That was expertly done. I'm not surprised, but it was worth a shot. I had to take it. Um, John, when you had mentioned interest rates in particular, but Joe, you sort of alluded to it as well. You guys both had picks in the financial sector that would certainly benefit from rates going higher. And when you look at the 10-year yield, you topped out around 175 in the first quarter. Second and the third quarter, we're down to below 120, and now we're right back up testing 150 again. Earlier, people talked about rates coming higher as sort of a sign of economic strength. Now all of a sudden, it's coinciding with a bit of panic. But one thing I think you can assume is that higher rates mean better for financials. I mean, in general, that's a huge tailwind for any sort of banks. Is there something? I mean, can you tell us just a little bit about how you're thinking of interest rates and what we should be expecting, or what you would expect between now and year end, where you've had sort of a drop and now a sudden rotation higher with funds going away from bonds?
Sure, if I can. Uh, Interestingly, that 170 area, that's just on the, yeah, right in there. That 170 area, if you took that chart back another year or two, that's a very important low at that 170 area. So when we came up and kissed that earlier this year, that was just not out of the blue. It really recognized that as being significant and it rolled down from it. And when I was a kid, I used to work in the bond pit. And I think the first thing I ever charted was the bond market over at the CME, which was the bond futures. And what I noticed right away is the bond market is funny in that it will stay in a tight, or interest rates and the yield of the 10-year, it'll stay in a tight range for a couple of months. And then bam, it just jumps to the next level. I think that next jump's going to be back to 170. And if we get through there, the next level on the top side is 205. And that all, some people call it the reflation trade. Some people call it the inflation trade. But that's, I think, really what's been spooking the market. It seems like there's been a real connection between this jump in rates. I think it caught some people flat-footed that it happened so quickly. And that's really kind of been it seems like it's been kind of an anchor on the stock market for the past few days.
It's absolutely right, and it's interesting. You mentioned a target above 2% on the 10-year. I've always been told, don't confuse the bottom of the page with support and the top of the page with resistance. And people, when they see rates go up, they think, well, that's it's gone up a lot. How many times have we seen over our careers? The market's gone up, and it can go way higher or way lower than you might expect, right?
Well, it's interesting. I keep some long-term charts of rates, and I probably have this off by a decimal point or two, but the 100-year monthly closing average in the yield of the 10-year is something like 4.7%. Just to put it into perspective, I think people get used to rates being this
Yeah,
low
yeah.
and just think, hey, this is crazy. We're at 170. But if you go back 100 years, it's somewhere in the mid fours.
What concerns me, we have a lot of newer investors, a lot of up and coming investors, novice investors recently that have come into the markets. And if you've been investing anytime, if your investing experiences in the last couple decades, you've known nothing but a falling rate environment, to be sure, right? I mean, rising rate environment is very different experience. I would think. Now, Joe, you mentioned in your comments, and all of you, to be honest with you, what I love about you guys and why I respect each of you in your approaches. You all have a component focused on relative strength and thinking about how these stocks relate to others. And I think there's a lot of wisdom in what you're doing. Joe, in particular, when we're thinking about relative strength, especially in this kind of environment, before we started, you were talking about how, a lot of the charts are going down, but the relative lines are actually helping you differentiate a little bit, right? Because you can see what's working and what isn't. Can you talk about in this sort of environment, when you get some dislocation, when you get the market dropping and it feels like everything's kind of falling off, how do you think of relative strength as a way to look for opportunities?
Right. So I actually, yeah, on my show, I just recently kind of talked about this. I actually think that when the market's getting hit, that is really the power where relative strength shows its power for me. I'm looking for stocks that are being resilient during a down leg, especially when we can get the market to do more than just go down for 3 days. If we've gone down, we made a rally, and we've made a lower low. If we start to sort of have at least a real correction, you can look for the stocks that are holding up. I mean, look at a JP Morgan, like you're showing, that isn't trending to the downside. It's actually at a new high. So yeah, that line will show that popping up, but I'm actually looking at the price action and comparing the bottoms. I'm looking for stocks that are making higher bottoms while the market's making lower bottoms. And those things tend to stand out. And then you don't have to always have to buy breakouts with relative strength and buy stock that's at a 52-week high. So that's the way I would look at it. But I can tell you that I spend a lot more time looking at relative strength when the market's getting hit like this, because I think that really, it just shows the stocks that I think are shining at that point.
No, it's absolutely right, this market sort of it's reminding me a little bit. It's of thinking of sort of that 2007, 8, 9 period where it felt at the very beginning, at least everything was rolling over, and all of a sudden you were able to differentiate things by the relative strength. Whereas before, it's looking at absolute prices. There are times when it certainly feels like relative strength is vital, and arguably we're in potentially this sort of environment. A number of you, and I'll just open this up to everyone. A number of you mentioned small caps, and I just wanted to mention, or point out, if you think of the market environment, this is one of the pages that I look at a lot. And here we have mega caps, the OEX, we have mid caps, and we have small caps. And the OEX, as you know, has been making a consistent pattern of higher highs even through early September. The mid cap and the small cap indexes have essentially been flat to down over the last 6 to 8 months, but a number of you really keying in on some of the smaller names and looking opportunistically at where there could be things that are rotating higher. What is there something that you would need to see from small caps? A lot of people are so comfortable with small caps underperforming and just stick with the mega cap names. Are we at that point where that is no longer the case and we need to be actively looking at small caps? Would you guys agree with that or disagree with that? What would you think?
Well,
Let me
yeah,
just, I wanted to follow up actually, because I brought up the Russell and how it had
Mhm.
been working sideways. And you can see that SML, it's been working sideways. So I guess my opinion is that right now, based on what I'm seeing, that does not look like a distribution top. It looks like a pause in an ongoing uptrend right now.
Yeah.
Now, I mean, you don't really get confirmation until this busts up through 1400. And, but if you go under the hood, you look at all 2,000 stocks, you can get a pretty good sense based on the pullback and the consolidation pattern, whether it looks like a topping pattern or whether it looks like more of a pause and an ongoing trend. So right now, I'm of the opinion, I mean, it can change. I mean, I might go through some stocks tonight and have a different feel for it. But right now, based on what I've seen up until this point, I'm of the opinion that this is setting up for another leg to the upside.
Yeah, I would agree with Joe on that. I think that we're going to see small caps break out, and it's funny because literally just a couple of hours ago, I wrote a blog article and pointed out. If you can go over to the articles for a second, Dave, I don't know, but I think I'm down just a couple there. Yeah, rising yields have a history. So we know that rising yields favor financial stocks, but I put a chart in there showing how small caps perform when yields are rising. They tend to outperform the S&P 500. There's a very, very strong positive correlation between the direction of the 10-year Treasury yield and the direction of the relative performance of small caps. So I think the fact that we're getting this breakout to the upside in the yields, and the fact that I think most people would agree that the long-term downtrend in rates is either over or pausing at a minimum, I think this is going to set up quite an opportunity on the small caps. And I completely agree that the small caps have been consolidating. It's kind of like when the market keeps going up and you're just so consumed with Apple and Facebook and Microsoft that you kind of forget that the small caps had a huge rally earlier in the year. And then when the yield started struggling back February, March, and on, that's when we went through that period of underperformance in the small caps and through that period of consolidation. So I would agree. I think we're going to see a breakout in the small caps, and I think it's coming soon.
Guys, listen, this has been a blast. We're out of time, which is so sad because I wish the four of us could hang out once a week or so. If we could make that happen, that would be awesome. You guys really have so much to offer, and we've gotten a little window into each of you in your process, and we're so appreciative for each of you giving your time. So Tom Bowley from earningsbeats.com, Joan Kosar from Asbury Research, Joe Rabil from Rabil Stock Research. Thank you guys all so much. Stay safe and be well. Thanks again for joining us today.
Thanks, everyone.
Thanks
Thanks a lot. Appreciate it.
So, folks, that is our show, The Pitch. As a reminder, it was just so much fun hearing from these three experts. You can find more about them and their points of view right on StockCharts TV. For Tom Bowley, he hosts Trading Places with Tom Bowley. Joe Rabil hosts Stock Talk with Joe Rabil. And John Kosar is a frequent guest host of Your Daily Five, which runs every morning on StockCharts TV. Check it all out on StockCharts TV. As a reminder, you can find more information about The Pitch, including all of our previous episodes, our guest experts, all of their picks, and make your own evaluation of those picks and how they've performed since then. To get all the previous episodes, go to stockcharts.com/thepitch. Also, as a reminder, go to stockchartstv.com. You can use your email address, set up a free account, and watch all of our shows on demand. Great commentary from people like John Kosar, Joe Rabil, Tom Bowley, many others. My own show, The Final Bar, which runs every weekday at the close, 4 p.m. Eastern. But all of that and more is on our on-demand platform. Go to stockchartstv.com or search on your mobile device for StockCharts TV on demand. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe, be well. We'll see you again soon. Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.